Hello everybody and welcome back to the special weekend edition of our daily show where we talk about stocks, commodities and cryptos. The biggest key level for the week ahead has to be to do with the stock market. The US Sp500, the defended area we discussed last week was held. The question is, can we get through this new supply resistance zone and then start to move back up and get some recovery in these markets? Well, there's a lot of things going for it, but unfortunately, as always, there's quite a lot of macro data that's pointing towards the other side. So as we have non-farm job payrolls and also the FOMC statement come out this week, there's so much to be worried about in these markets. Stay tuned as we take a look under the hood at what the market's doing and whether it's rotating, showing us signs of weakness moving forward. See you soon. This will be a good one. Well, welcome back everybody, and let's get started by talking about some macro information. Then we'll get into some charts, talking about some commodities, and of course, then we'll get into some individual stocks, including Tesla and indices. Firstly, it's all about the worst year on record since 1932. Yeah, we're in history and not really the history that most of you would probably like to be in. The big difference between this fall and other falls in the past is the difference between 50-50 bond portfolios. A lot of people consider 50% bonds, 50% growth stock to be what they call a balanced portfolio. Look at the returns for 2022 in comparison to any other year for these types of portfolios. It's shocking. And of course, that's why up until 6 months in, the 1932 crash is the only one we can compare it to. Now, what about what the economists said for 2022? Well, we knew it was going to be a traders year here on the channel. We've spoken about that a lot. Midterm election years tend to be so, but now we've had inflation, we've had war, we've got all these other problems. Here are some of the forecasts, and this is why you've got to be very careful in the future of the forecasts that come out. Look at the changes that have been made. Though Bank of America, I've got to say, they're staying firm. 4,600 at the beginning, 4,600 reiterated in March, and 4,500 by year end reiterated as of the end of June. What a funny chart that is when you consider where we are in these current markets. But most of them have dropped, and you'll see the considerable drops anywhere from 5,000 all the way down into some of them actually going as low as 3,900, such as Morgan Stanley for the end of the year. So this is the current forecast for the S&P 500. What do you think your forecast is down below? Let me know in the comments. I'd love to see everyone putting in their numbers for where the S&P 500 is going to be as of the end of the calendar year. So when we're talking about fastest falls on record, all of these types of things, the question always comes up, well, where am I going to buy the dip? We haven't seen any signs yet other than small technical rallies that are showing us that there are bulls around, that there is any demand. The big problem is when you look on the charts, when you look at the asset flow, unfortunately, as you'll see today in the video, so many big players are still selling this market down, as in they're adding to their shorts. That's not the type of market you want to be making big long-term potential investment decisions in, unless you have other criteria that you use. Let's talk about these other things that are going on here in terms of PE. Well, PE has shown us some good signs. Forward PE has dropped to the 25-year average. In some ways, that's a miniature tick for a lot of people out there. At least we're back to the average and we're not elevated as much as we were. But other things such as Schiller's PE, of course, still quite high. I know it's based on the 25-year average, but that's really destroyed by, of course, what happened during the tech boom and what happened in the last couple of years for the Schiller. So the Schiller still, I think, very elevated from where it should be. It should really be about a 22 ideally. Div yield, we're sitting pretty much at the same point as we used to be, a little bit worse. And of course, the rest there. So most people are looking at PE and forward PE. I like to think of it as that's probably the number that we do want to watch. And as you can see on the right-hand side here, it's coming back into a way more fair zone. We're on the 25-year average just underneath. What if we enter -1 standard deviation? Is that the area where people will buy? In 2020 it was. Will it be again? I would have a suspicion that a lot of big funds will be looking at that kind of level. Speaking of big funds, of course, we're in July, and July does tend to be one of the better months of the year. Now, obviously, this year has not necessarily followed a lot of the seasonal kind of complex ideas that you can put out there. But first day, so far so good. 27 of the last 33 days. The 1st of July has been a positive day, and it was again on the Friday session. The week after Independence Day, and of course, a massive shout out to everybody in America. Hopefully you're having a good weekend and you enjoy your Independence Day long weekend. So the market will be closed on the 4th. But when we get into the 5th, the 6th, the 7th, the 8th, some interesting things do occur. Well, firstly, we end up getting a few positive days, but often a lot of elevated volatility. I don't expect that to be any different with the big news that's coming out, especially on the Friday. You'll notice here that the Dow is usually up on the 6th, 1.4%, up 16, down 5. So a pretty big one, FOMC minutes due that day. Then we get a little bit of some extra little gains here in this week. And then we head into, of course, the 3rd week, which will set us into options expiration. Notice here, expiration day, Dow down 15 of 22. So not a good day on that option expiration day in terms of the general kind of sentiment that comes into these months and into this point. This is going to be a very interesting month. I think there is a case to be said that we might continue a little bit of a rally here, especially if we break through a key level we'll look at soon. But yeah, after that, I'm telling you, there is a potential here for further shorting, and I'll show you why. The main reason is leverage money and leverage shorts. Look at this graph here. Remember back in March when we saw that March fall off. Now, in general, this is not a timing technique, but when we start to see leverage money starting to play in the markets, that is, it starts to increase and increase and increase, it's hard to really not pay attention to that until it, of course, decreases in the market and actually goes back to net zero. This is the net amount. So basically there is more, or there are more negative positions being placed than positive. It doesn't always happen like that, but at this point, we're back to where we were in the 29th of March. After that, April, of course, kept rallying a little bit, and then it dropped off. Remember, they don't tend to have stop losses, these guys. So when they're in leverage positions, unless they're dumping those leverage positions, you can't really trust the rally so much. And in this case, all they're doing is each time it's been rallying, what have they been doing? Well, they've been adding to the position. So if we do rally, this will be an important channel to follow because I will be bringing you up to date with these numbers as we start to see them coming through over the next couple of weeks. I particularly think this weekend coming up, the next weekend, will be an interesting one because to see how they rebalance, to see how the market's structuring will give us key insights into whether this market is actually rallying really, or if it's rallying with a lot of Wall Street additions to the short side. So stay tuned for that. What else has been happening in the markets? Well, we've still seen the markets going towards a defensive slip. And that means that the last couple of days, especially around June 24th, where we suspected this might be occurring, it wasn't really about the NASDAQ and it started becoming more about defensive components. As we're rallying up a little bit further and then start dropping, what happens? The Dow holds slightly better. So we saw the NASDAQ fall in line, a lot to do with the Sp500. It fell a little bit more. And then we talked about how when this recovery was going to happen, and if it did, it was going to most likely be the NASDAQ that outperformed. That is what happened. We got the biggest switch, negative 12% up to negative 4% over that period. So a bigger switch than the Dow and the Sp500. But this time around, it's not looking the same way. As this market falls, expect the NASDAQ to get hurt still very much so. And it's all got to do with the semiconductors. And we'll take a look at those very, very soon in today's video. Let's have a look at the VIX. Well, it's back down to 26.71. We're not back to our magical 25 level, but as anyone would know with the VIX, we like to look at 35s, 25s, and 20s that are giving us a little bit of an idea about whether the fear is in the market at this stage. And if the VIX does drop this week and we see the market rally, remember, just because the VIX is going down, it doesn't mean that everything's turning around and it's all great. It can come back up at any point in time. And that's what we've seen happen a few times this year. Look back here in April. And remember, if the leverage positions are increasing and we're back here in the 20, we probably still want to pay a lot of attention to that. And VIX traders might actually look for a spike around that time. Some good news for the markets, though, were the yields. Now, whether that's some kind of destruction or sickness in the economy, I think it probably is. But we did see yields drop, and that is the 2-year and the 10-year yields. Now, before we talk about those, we need to talk about the correlation between the stock market and the US dollar at the moment. So this is the US dollar up here. and you can see it's in a supply resistance area at this stage, and you can see the market itself. When the US dollar has been going sideways, the market has been at that point allowed or potentially allowed to go back up. When the US dollar is making new highs, and if that happens this week, watch out because it's going to be pretty aggressive, I'd say, then the market has been dumping. Look at this rally, look at the dump that's going on. So watch the US dollar very closely. You have to have that. Basically, cash is king at the moment, as most people are saying, and until that becomes not true, this is one of the biggest correlation charts that you can be using. US 10-year, as we mentioned before, fell drastically on the Friday market. This is really just a big signal here that maybe there's a bit of demand destruction going on. I think we all know that. Demand is the thing that the Fed can control in some ways. By raising rates, they kind of make everyone feel poor. Your house loan goes up. Everything kind of becomes bad. And of course, they're trying to kick inflation's ass, though they're not going to do it like they did in the 70s because they just won't be able to. Let's take a look at this support area here, or demand zone. This is not broken yet. A huge break this week will be through that area, and that's going to sit around 2.741. So we get a break below that, I think that we're looking at some serious turnarounds in the market. I'd also like to just say at this stage that our premonition of certain things is starting to come true, and we'll put this into a special video before the market open, which if you subscribe, you will get. And this special video will come out this week. I'm going to be talking specifically about yields and how the packing price looks, because basically at the moment it looks like this. The yield curve's going up, and the bond market is currently telling us that in the back end of 2023, the Fed's going to have to cut the rate. And what is interesting about that is it's basically saying the Fed's going to have to increase the rate, then it's going to get so bad in the economy, they're going to have to cut the rate to potentially avoid a recession or already be in a recession. And that is an interesting one because, as we know, when the Fed cuts, whether we are in a recession or not, they have a 5 out of 7 track record. So 5 times out of 7, they caused a recession when they cut. So whether we have a recession now or we have a recession in the future in the next 4 to 5 years, it almost seems inevitable it's going to happen because the cutting is just going to be so sick. Imagine raising rates to 2.8%, then having to cut them all the way back to 1.6. And even though that might sound really cool and, oh, that's good, we get cheaper rates, that cutting effect, 5 out of the last 7 times they failed at it. So stay tuned for that video. Very, very important stuff. As we mentioned before, the US dollar is finding some supply resistance kind of level here, and it's kind of shorting off that zone. You'll notice that it just made a new high. It was actually quite sneaky on the trade on the Friday session. We'll talk about that in a minute, but yeah, this is double rejection now. A new low is going to be super significant coming off a double rejection like this, and I think I'm going to be looking for stuff like that this week, and we'll certainly be following along with it. Now, in the previous video, we spoke about the concept that this was a bit of a change of trend. And I firmly believe in that kind of concept. And of course it was, in my opinion, a first time frame change of trend. The market then went to make a new high, which I think is unbelievably sneaky. And if it does end up making a new low, wow, it was a super good trap here at this point to get rid of, I guess, the weak kind of shorts. The area that you would have been trying to short in though was here. And there were a couple of little triggers that you might have got in a 5-minute chart. The importance of this is, remember, it's not always 100% that you're going to, even if you find the right area, the statistically correct zone, you're not always going to have the correct short, and it isn't always going to work out. That's why it's so important to have your tight stop losses when you're doing this, because when you place these types of positions, you're looking for 5 or even 10 to 1 style trades. That is, you put down $100, you're looking for $500 or even $1,000 from that risk. The reason is because you're being patient, and you're being patient and you're reacting and you're not really predicting. And by being patient and making those decisions, you get your higher payoffs. They don't always work though. And at this stage, if this was a sneaky breakout to take the last liquidity on the US dollar, it'll be a big one. So watch out for the new lows. And of course, definitely be watching this chart this week. Let's move over to gold here quickly. Gold, another one that broke low. I stayed clear of gold the last 2 days. As we discussed, when it broke below that 1810, anything was possible. We've gotten down to what we call the defended level again. Notice the new break low here underneath this point. Could this have been stealing liquidity? Based on the price action, you would say yes. It instantly bounced off this point and just went boom, straight back up. But notice the defended area. This was the first one we discussed back, a month ago. and we're discussing it again. Now, I've looked at the numbers for gold. I don't actually see any big investors at the moment that have come back in. I think this week's numbers will be very interesting to see whether they are coming back in. The price action is going to show us anyway, but at this stage, there's been mostly just a reduction over the last couple of weeks of longs in Wall Street. That trend line's not very good. But if you see here, the couple of hammers that we've got down the bottom, that was a very strong hammer kind of pickup. There was a decent amount of volume here, and all of a sudden gold just slingshotted off that level. If you were looking at this level and you saw these 2 1-hour areas of tweezer lows, I think that would have been an okay scalp. Certainly a very, very nice day trade, and that is the type of candle pattern I very much like. The tweezer is a big deal. In fact, we have a tweezer in just a few moments we'll check out. Oil did bounce. I've been pretty negative on this pair. I've obviously been looking for the turnarounds. Again, I looked at the numbers. Wall Street, the bigger players, there's still net long in oil, so betting against it is very tough. I'm more neutralized in some ways than anything else, but I have been looking at shorts. Obviously, once it reduced underneath here, I went short on this type of level, and we ended up getting a decent little kind of move there. Now it's coming back up. The key level for this week is going to be really around here. So this is going to be a very, very key zone. As you'll notice, we had that previous little bit of resistance. We've got the daily shooting star down. All the battle between the bulls and the bears should happen around this zone, around that 110. So watch that pretty closely. If you get turnaround story, something like, it starts to go up and then comes down, goes through here, I think it will probably make the new low. If it doesn't and it ends up breaking up though, be very, very careful. That could mean that oil is going to explode out of the gates. And as I said, there's a lot of big players that are still heavily long in the oil trade. Now, here's where markets get very, very scary. Semiconductors versus the S&P 500. Check out this chart. A big walloping sell-off. Even though it looked like everything was looking okay on the Friday market, take a look at this on the daily. We scroll down and it was a sell-off fest. Semiconductors versus the S&P 500. The biggest and possibly the most well-known kind of good sector of the last decade is finally dropping significantly. Now, if you're in this type of one, you can see the big change that occurred here. But the reason why semiconductors are so important, it's kind of like the lifeblood of the, I guess you would say, the phone industry, and obviously of anything to do with semiconductors and to do with growth. And this has now kind of begun what you could say is a Wyckoff. We've got that UT. We've obviously got the breach below. Is there a lot more to drop here in semis? This does not look positive towards that market, and certainly it could mean risk is off, and what we might see is more rotational flow into defensives if we continue to see this bull rally. We'll need to watch the sectors very closely. Semiconductors not doing well in the market. XLY, XLP, consumer discretionary versus staples, basically the 1/3 of the US economy being the American consumer. That is represented in this chart, and again, pretty weak, still holding the support as best as possible, but coupled with semiconductors, it doesn't look like the risk on trade is there at this stage like it was a few weeks ago. LQD, bond indicator, and the bonds in general, this is just the corporate bonds here. They went up, but I can tell you that it was a pretty lackluster kind of rally considering the amount that the yields dropped. Still be very, very careful in the bond market at this stage, and we'll have to continue to watch yields. But if yields keep dropping, I'll be there talking to you guys about bonds, because bonds could be seeing a little bit of inflow, and you can kind of see that in the volume down below here compared to what it was stabilized around the other time. We'll continue to watch. Tesla, not much to say other than it held okay through the session. We have that little bit of a resistance here at 690. I think day traders are going to be looking for this coil. Break below this little low here. What's going to happen? Back into demand around 620. Break above this little level here. Really good chance that you might start to see some rallies back up into like that 740 plus range. So a really nice little coil here on Tesla, and it's consistent with what we're seeing in the other markets. So I promised you guys a tweezer before. We've actually got a double tweezer. We've got the tweezer on the DAX. This is the German 40, and you can see when it followed through. So this would be similar to the dollar index if it happened, had that massive short off into the demand zone. Now we've kind of got the rejection here of that What happens if we get past 13,000? Probably a good sign that maybe we've got further recovery going on. Super mixed signals. We've got the short signal, we've got the long signal, and bears will just be looking for a new low here. They get a new low, they might. I don't know. I think it could be bad, guys, if that happens. What do you think? New low underneath the tweezer, takes out all of the longs, liquidates them, and then all of a sudden we're on for the big short. So watch the DAX this week, could be important. Let's move over to the NASDAQ. As you can see, pretty lackluster rally considering what happened to the S&P 500. It all started with this big trend line that we had on the way down. So there was the trend line we mentioned a few weeks ago. We've filled every single one of these gaps that's down here. Obviously, we still have a little bit of gap left at the top. And for people that trade in the NASDAQ, I still think the S&P 500 might be the best go. So that basically means that this resistance level here, when it breaks, expect that the S&P 500 will have already broken above. So let's have a look at the S&P 500 now. Here's the daily. You can see the long leg doji, slight close above that, possibly an okay sign. Dojis usually hold some orders, so that will be an interesting one to see where this holds. The point of no return, that big defended line did hold up, and we still have this gap up here for anyone that hasn't been watching, and the trend line down. So what if it did this? Boom, bang, and then we bust back down. That would be kind of my ideal scenario here for the S&P 500 for the next week. The rally hits the trend line, fills the gap, and then we see that turn because we know there are so many shorters still in this market. Maybe they reduce though, we'll have to find out. US 500, here it is. Here's the defended area we spoke about. I'll give everyone a clap in the Discord community. Well done to the public Discord and private Discord. Some of the mods and actually all of us really kind of figured out this zone together, which was spectacular. If you haven't already joined the public Discord, you can do so with free links down below. And of course, if you ever want to become part of the private community, we have a free 7-day free trial as well that you can join in the links down below. And we do extra private streams for the pre-market, etc. there. Yeah, it was a really good area. We did see the bounce. We had 2 potential trades off this level. And now it's moved up to the big zone. This is a previous kind of supply, previous issue area, previous supply before we breach through, and then we can continue up. And as we mentioned, that's where we would move towards that, I think, the downward trend line on the S&P 500. So be very careful about this high here, 38.35, and of course the low of 37.40. If we breach either side, it's probably not going to be good for the other side, people. So if we get to the top, I'd probably expect us to keep rallying for a little bit. If we get underneath, I expect us to obviously start shorting relatively fast. If you haven't already, come and follow us over on Twitter as well, at FX Evolution's our handle. And let's have a look at the crypto markets. It's been pretty stagnant here. I wish I could bring more, but I will start to do a lot more analysis for the crypto fans out there when we see some signs of life. At the moment, the problem is that this is a very dangerous market to rally and actually trade in general. It's not easily, let's call it replicable. And I like to replicate concepts. And at the moment, look at this huge rally. Like, what is this? And then just dumps immediately off. To get those types of things are going to be tough. And to also be correct enough percentage for you not to be just flipping coins is going to be tough. So yeah, we'll keep watching it. We've got some ideas. I still am not a super horror bear on it forever on Bitcoin. I just want to see some signs of life, and we'll follow it together on the channel here. Some big news for the week. Obviously, we've got the public holiday in the US on July 4th. Then we have the cash rate coming out for my country, which is Australia. Expect a big rate hike, everybody, and expect that also to have some serious downward pressure on our property here in Australia. I wouldn't be surprised if we fall in the vicinity of 15 to 20% as the cash rate gets hiked here. We're very susceptible to interest rates here in Australia. FOMC meeting minutes, that's going to be a big one as well. And this is also job openings day. So that's Wednesday, July the 6th. And we've got 10 a.m. and a 2 p.m. That's going to be a big one. And then we move through. We've got the first ADP non-farm employment change. Usually that's not that big an event. It can often be a false signal. And then we get the big kahuna here. We got the non-farm employment change, the jobs numbers. Now, although the jobs numbers probably lag in the economy, what an interesting number it'll be. So that's Friday, 8:30 a.m., 1 hour before the market opens, the US market opens. Big numbers coming out here, guys. I hope you have a great week. Have a great weekend to everybody that's in America. And of course, if you haven't already, consider subscribing, smash that like button, and we'll see you in the community or in the next video, which we'll be doing before, of course, the open. Yeah, special video coming talking about rates and what the bond market is telling us about what the Fed is going to have to do in the future. It's super, super interesting. See you then. Bye for now.